Amazon topping estimates for the fourth quarter earnings and revenue, but it did issue disappointing guidance for the first quarter, and that's a big reason why you're looking at shares off nearly 3% so far in early trading. The tech giant expecting a hit from FX rates. Joining me now, we want to bring in John Blackledge. He is the TD Cowen's Managing Director and Senior Equity Research Analyst. It's great to have you here, John. Let's talk about some of the commentary that we got out from Jassy on the call last night. A lot of it was focused, or some of it was focused on the AI spending plans, what exactly that looks like. I think that eye-popping number, just over 100 billion, might have been a bit of a surprise here to the street. But I think also just in terms of their ability to keep up with AI demand. What was your big takeaway?
Yeah, so they did guide to 100 billion-ish in CapEx, and that would be up a little over 22 billion dollars versus 24. And they said the vast majority would go to AWS and the AI infrastructure build out. And we were at 95 billion in total CapEx. Sell side consensus was 84 billion. So it was a bit above the sell side consensus. We were kind of there. I also felt investors were around 95 billion. So not, it was above, but not, and I think people were bracing for it with the Meta results and Alphabet results. And to your question on the capacity constraints, yeah, I mean, CEO Jassy said, listen, like, we think AWS revenue growth would have been better, absent the capacity constraints. That was also consistent from, kind of from what we heard from Microsoft and Google. And he said, with the capacity that they're going to bring online, it should be alleviated by the back half of the year. So that should be good as we round through the year for AWS revenue growth. And then he also said, like, we are making these investments. And historically, when we've done this and accelerated spend, there's revenue opportunity on the other side of it. And he called out that the AWS generative AI revenue is running in kind of like the multi-billion-dollar range, growing triple digits.
So then is the stock reaction today a bit of an overreaction?
Yeah, I mean, it's been a good start to the year. And just around the edges, and then you even referenced it, CapEx was a little bit higher. So, investors' CapEx, sell side CapEx goes up. 1Q guide, the revenue guide was a little bit light at the high end relative to sell side consensus. And you mentioned the FX drag and the leap year drag. And then the operating income guide was also a touch light. But I mean, all in, it was a pretty solid quarter. 4Q beat on revenue and crushed on op income, and so all in fine. So it's down a couple percent today. Let investors regroup, and it should still be a really good year for Amazon shares.
John, where does Amazon sit in your coverage list? I believe you also cover Meta is one of the names that you cover, and I believe Alphabet. How are they positioned relative to those two?
Yes, yeah, we cover Amazon, Alphabet, Meta, Netflix. Amazon was our top pick going into 2025. And some of the reasons were, kind of strong AWS revenue growth. Second was continued margin expansion. And we actually, off of earnings last night, we raised our margin estimates and our operating income estimates. And then the third point, which we haven't really layered in before, in one of the parts of the thesis, is that we have free cash flow growing over 50% in 2025. And we just talked about this massive, kind of increase in CapEx over the last couple of years. Despite that, we have CapEx over 50%, and that's due to the ramping margins that we've seen at the company, led by AWS, which posted a 40% margin ex a one-time item in 4Q. Their advertising business growing high teens, super high margin.